Hello and welcome. In this video, we will learn about price to earnings ratio or the PE ratio. Okay. First, we will learn to calculate it and then we will learn to use it. Alright. Now, this is the formula to calculate PE ratio. PE ratio is equal to current market price divided by earnings per share. What is current market price? Current market price is the price at which the stock is being traded in the stock market or on the stock exchange. Meaning, if you want to buy any share, how much do you have to pay currently, today, right now, on the stock market and on the stock exchange? That is current market price. Okay. Earnings per share, anyhow, we know what it is, correct? So current market price divided by earnings per share gives you PE ratio. Alright. Now, let me take an example. Let us say that the current market price of a company is 600 rupees. Meaning, if you want to buy one share of the company right now, you will have to pay 600 rupees. Okay. And let us say that the earnings per share of the company is 6 rupees. So 600 divided by 6 gives you 100, which will be the PE ratio of the company. Okay. Now, let us take a situation and try to understand PE ratio better. Let us say that we are comparing two companies, company X and company Y. And both companies are manufacturers of cement. Okay, they make cement companies. Now let us say that the current market price of company X is 600 rupees and earnings per share is 6 rupees. So 600 by 6 gives you 100 and this would be the PE ratio of X company. In the same way, let us assume that the current market price of company Y is 400 rupees and earnings per share of this company is 40 rupees. So 400 divided by 40 gives you 10 and this would be the PE ratio of company Y. Okay. Now, what is PE ratio? What does it tell about the company? There are a lot of ways to interpret and understand PE ratio. Let me tell you a couple of ways to understand PE ratio. Okay. If, for example, you buy one share of this company X by paying 600 rupees, and if the company gives 6 rupees earnings per ratio every year, then to get back your 600 rupees, it would take 100 years. Okay, once again, let us say that you pay 600 rupees in the stock exchange and buy one share of this company X. Okay, let us say you buy one share. Let us assume that the company keeps this constant, or let us say the earnings per share remains constant throughout the years at 6 rupees. Then for you to get back your 600 rupees that you had invested or spent on buying the share, you will have to wait 100 years. Okay. Same way here. Let us say that you buy one share of company Y by paying 400 rupees today. And let us say that the company will have earnings per share of 40 rupees throughout the years. Then for you to get back your 400 rupees, you will have to wait 10 years, or in other words, it will take 10 years for you to get back your 400 rupees that you had spent in buying one share of this company. Okay, that is one way to analyze this. Now tell me, which is better, PE ratio of 100 or PE ratio of 10? Is it better if the number of years to get back your money is higher or lower? Obviously it is lower, correct? Yes. But then once again, looking at PE ratio, we cannot decide anything. So let me tell you one more way to interpret PE ratio. Okay. To earn 1 rupees, how much rupees are you ready to spend? That is PE ratio. So PE ratio is 100, meaning people are ready to spend 100 rupees to earn 1 rupees. Okay. Here PE ratio is 10 rupees, meaning people are ready to spend 10 rupees to earn 1 rupees. Okay. Now, which is better? Spending 100 rupees to earn 1 rupees or spending 10 rupees to earn 1 rupees? Of course, this is better, correct? But then once again, you cannot decide a company based on PE ratio alone. Now the question comes, why do we say how much people are ready to spend? That is because the current market price is decided by people, correct? Current market price is decided by people. That means people tell how much they are willing to pay to buy one share of the company. So here, if it is 600 rupees, it means that public are willing to pay 600 rupees to buy one share of X. Here, people are willing to pay 400 rupees to buy one share of Y. If people were not willing to pay 400, then it would not have been this. Correct? Yes. So, since PE ratio depends on current market price, this is how much people are willing to pay to earn 1 rupees. So, 100 and 10. Okay? Yes. Now, current market price here is 100 times of, current market price is 100 times of earnings per share. So here current market price is 10 times the earnings per share, correct? Yes. Now, let us say that the average PE ratio of cement industries is 40. Let us assume that average PE ratio of cement industries is 40. We have something called as sector PE, which is nothing but average PE ratio of that particular sector. So here I am taking for example cement sector, cement companies, correct? So let us say that the average is 40. Alright. Now, when you compare average PE ratio with the PE ratio of the company, you can see that the company X is overvalued. Why is it overvalued? Because the PE ratio of company X is higher than the average PE ratio of cement industries. Here, the company Y is undervalued because the PE ratio of company Y is lesser than the average PE ratio of the industry, cement industry, 40. So here it is 60 more than 40, here it is 30 less than 40. So X is overvalued, Y is undervalued. Okay. Now, why is it overvalued? Why is it undervalued? There will be many reasons which you will have to find. Okay. Now, what does it mean? What does it mean when we say company is overvalued? What we mean here is the price of this stock or company is costly. 600 rupees, which is the current market price of this company, is costly. That is what we are saying by saying X is overvalued. When we say Y is undervalued, we are saying that this cost of Y, this current market price of company Y share is cheap, or in other words, we are getting this at a cheap rate. We are getting this at a costly rate. Okay. Now the question comes, why are we getting it at costly rate? Why are we getting at cheap rate? Think of this like this. We are getting it at costly rate because people believe in this company. We are getting this at a cheaper rate because people do not believe in this company. That is one way to put it. Okay, that is only one way to put it. The reasons may be many. Now, people believe that this company will perform better in the future. This company will grow well in the future, and that is why they are willing to pay more to earn less. They are willing to pay 100 rupees to earn 1 rupee. Whereas here, people do not believe that the company will do better. I mean, they believe, but then they are not so hopeful about the company. So they are not willing to pay more to buy the shares. Here people are willing to pay only 10 rupees to to earn 1 rupee. Okay. So that is one way to understand it. Now, it does not mean that the company is good if PE ratio is good or high. And in the same way, it does not mean the company is bad too. Here, it is same. It doesn't mean that the company is bad when looking at low PE ratio. It also doesn't mean the company is good too. Okay. Now let me give you an example to understand this. Let us say that there are two hotels. Okay. This hotel, this hotel. In this hotel, one plate of masala dosa is selling at rupees 100. Okay. If you want to eat one masala dosa at this hotel, you have to pay 100 rupees. At this hotel, if you want to eat one masala dosa, you will have to pay 20 rupees. That's all. Okay. Let us say that average industry, dosa industry, average cost is 50 rupees. Meaning, if you go to 100 hotels, in most of the hotels, the rate will be 50. You can assume it like that. Okay. So let us say that the average cost is 50 rupees. So this is overvalued, correct? This is undervalued because this is higher than 50, this is lower than 50. Now, why is this overvalued? What is the reason? See, this may be a very good restaurant with good lightings, with good infrastructure, with good ambience, with good waiters, or they may be using very good ingredients, they may be using very good plates, and also ultimately the taste may be good. Okay, taste may be good, and that is why they are charging 100 rupees per plate. All right, let me stop here and proceed to this. Why is this cheap? Why is this cheap? This hotel may be a small hotel or it may be a cart too. Okay, they may be using substandard ingredients. They may be giving it in a plastic plate or a paper plate. You may have to stand and eat the dosa. There may not be any infrastructure in the small hotel too. And that is why this is cheap. Okay, that is one way to look at it. Now, another argument goes to, even though you pay 100 rupees, this may not be worth 100 rupees. Many times you might have gone to a hotel, have eaten something, and when you pay the bill, you feel that the price that you are paying is way too high for the taste that you got. Okay? Let us say you eat this dosa and you feel that 100 rupees for this dosa is not worth the price. The taste might not be good. The ingredients used may not be good. We do not know what ingredients they use, correct? It happens in the kitchen and we do not generally have access to it, right? They have fixed 100 rupees and we are paying it, that's all. So, that is one argument. Let me come back to this. Here, even though it is at 20 rupees, they may be using very good ingredients. They might just have kept their profit margin less. And this dosa might be very tasty. Alright? And you might have felt the same too. Sometimes you go to a cart or a small hotel, eat something, and when you pay the price, you feel that it is worth the price, or you feel that it should cost more due to the taste. Okay? So, this is one argument. So, what I am trying to say is, just because this dosa costs 100 rupees, it doesn't mean that this is good. It doesn't also mean that it is bad. Similarly, just because this dosa costs 20 rupees, it doesn't mean it is bad. It doesn't mean it is good too. Okay? In the same way, when we say X is overvalued, Y is undervalued, it doesn't mean this is good or bad. This doesn't mean it is good or bad. It just means that people are willing to pay 100 rupees here to earn 1 rupee because people believe in this company. Here people are willing to pay 10 rupees to earn 1 rupees because people are not willing to pay more here to earn 1 rupee. Here people are hopeful, saying that if I even pay 100 rupees, I will guarantee, I will surely win, or I will surely earn 1 rupee. I am willing to pay 100 rupees because I know this company will perform good and I will earn 1 rupee. So here they say that I am not so hopeful about this company, so I am willing to pay only 10 rupees to earn 1 rupee. Okay? So this is what the condition is. You cannot decide a company by looking at PE ratio alone. Alright? So as you proceed through the video series, you will try to, you will learn to understand how to use PE ratio. But for this video, this is enough. Okay? Now let me go to moneycontrol.com and show you the PE ratio analysis. Alright? Alright. So I have opened up the page of Shri Cement's company on moneycontrol.com. You can see the current price of Shri Cements is 27,670 rupees, meaning you will have to pay this much rupees to buy one stock of this company. If we scroll down a bit, you can see that the sector PE is 52.66. 52.66 is the sector PE, means average PE of this industry or sector, okay, cement sector, 52.66. Now, if we go to financials and go to ratios here, and if we go to valuation ratios, we can see PE ratio is 74.36. Okay. Now this is higher than average sector PE, meaning this is overvalued. Okay. Now just because this is overvalued, it doesn't mean it is good, it doesn't mean it is bad. You will have to look at other factors too. Now let me come to one more company, Ramco Cements, and its current market price is 1019 rupees. Okay. The sector P is 52.66, doesn't change. If we go to financials and if we go to ratios and if we go to valuation ratios and if we look at PE ratio, it is 54.05. Okay. Now this is almost equal to the sector PE, correct? almost equal to sector PE. So we cannot say this is overvalued or undervalued too. This is worth the price. Now, just because P ratio is near to the sector P ratio, it doesn't mean it is good, it doesn't mean it is bad. You'll have to look at other ratios too, other things too. Okay? But what you have to do generally is, before investing, you'll have to look at the PE ratio and compare it with sector PE ratio and also other companies' PE ratios too. And only after that, only after analyzing using other ratios, other things, you can go ahead and invest in that, or at least I follow that rule. Okay? Yes. So I think this is enough for this video. I'll see you in the next video. Till then, take care and thank you for watching.